Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.
Disclaimer from the always present legal team: podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
If you're an entrepreneur and you're thinking about selling your company, or maybe you're an advisor in the middle of a big takeover, you always come back to one really simple gut check question.
What have similar businesses actually sold for?
Exactly. And that question, it isn't just, idle curiosity. It's really the bedrock of valuation reality. Today, we are doing a deep dive into the method that answers that question. Precedent transaction analysis, or PTA. This is one of the big three, one of the foundational pillars of corporate valuation.
It really is.
Our mission today is to go past the textbook definition and actually walk you through the mechanics step by step, showing how you can use real-world data to find a realistic, defensible value for a company.
And that word realism, that's the whole game here. PTA is all about estimating a company's fair value today by looking at cold, hard historical evidence. I mean, what multiples were actually paid when similar businesses got acquired. It anchors everything in actual buyer behavior. And for this deep dive, we're really leaning on the work of valuation expert Himanshu Kandoy. His guide on this is incredibly detailed, and it helps us break down not just the math, but the really critical judgment calls you have to make.
Okay, let's jump right into that. Let's unpack this, because I think most people have heard of public market comparables. You could look up a stock price.
Sure.
So why do we even bother with PTA when we have trading comps that show us what public companies are trading for, every minute of the day? What's the real fundamental difference?
That is the single most important question. It's the big split in valuation theory. When you look at trading comparables, you're seeing a public market price.
Right.
And sure, that price gives you liquidity, but it's what we call a minority interest basis. If you buy 100 shares of a public company, you get basically zero say in how that business is run.
None at all.
PTA, on the other hand, that reflects what a buyer pays for control, for the whole thing. And it captures two huge elements that public prices just don't. First, you have the control premium. That's the extra amount someone's willing to pay for the right to actually make decisions, to change strategy, to fire the CEO, whatever. And second, it captures the value of strategic synergies. The cost savings or revenue boost from combining two companies.
So let me see if I've got this right. If a big competitor is willing to pay, say, a 30% premium over the stock price because they know they can fire a whole redundant sales team and save millions, that premium only shows up in the PTA data.
You've got it. That's it, exactly. That difference, the control, the synergies, that's why the multiples you see in PTA are almost always higher than what you see in the public markets.
That makes so much sense.
And this makes PTA absolutely vital, especially if you're working in, say, the lower middle market. I mean, for a lot of those smaller private companies, there are no public comps. You have to rely on what similar private businesses have sold for.
Okay, so where does this approach really shine? What are the key applications?
Well, it's pretty widespread. First, obviously, is M&A advisory. It helps you estimate a realistic takeover value. It sets the goalposts for both the buyer and the seller right at the start.
Right, gives you a starting point.
Then it's a huge tool in deal negotiations. It gives you empirical proof for your price. You can literally walk into a room and say, look, a business just like yours sold for 10 times EBITDA 6 months ago. That's powerful.
And I'd imagine it's a great reality check, too.
Oh, a critical one. We call it a valuation cross-check. If you spend a month building this beautiful, complex DCF model and it spits out a value of, say, $100 million, but the PTA on 5 recent deals shows they all sold for between $150 and $180 million, you know immediately that your DCF assumptions are probably way off. It grounds your forecasts in what's actually happened.
Perfect. That sets the stage beautifully. We know the why. So now let's get into the how. I know the process can seem a bit intimidating, but it really breaks down into a pretty clear 7-step workflow. This is what analysts actually do day to day.
Right. And it starts with what we call data gathering and normalization. So step one is probably the most fundamental. Identify relevant deals.
Okay.
And this isn't just, finding any old acquisition. You have to find deals where the target company is almost a mirror image of yours. Same industry, similar size, similar business model, same geography. Similarity is everything.
So you can't compare a software company in Texas to a manufacturing plant in Germany.
Not unless you have a very, very good reason. Step two flows right from that. Collect comprehensive deal data. You need all the details. The final price, the deal structure, was it all cash, stock? And critically, how much debt and cash did the target have when the deal closed?
That sounds like a ton of data to sift through. So after you have that mountain of information, you have to, standardize it.
Exactly. That's step three. Compute key multiples. You're translating all these different deals into a common language. Usually that's enterprise value to EBITDA, maybe EV to revenue.
And why enterprise value? Why not just the sale price?
Because an acquirer is buying the entire business, warts and all. That includes the debt. Enterprise value, which is the equity value plus net debt, reflects the total price tag for the whole operation. It's the right metric for a control transaction.
Got it. Okay, now, step 4 sounds like where the real thinking comes in. Adjust and normalize. Why is this filtering step so important?
Because history is messy. Not every deal is a good comparison. You might find one company that was sold in a fire sale because they were about to go bankrupt.
So they took a huge discount.
A massive discount. Or you might find another deal that happened at the very peak of a market bubble 5 years ago. That multiple is inflated and, frankly, irrelevant today. You have to screen out all those outliers to create a clean, defensible data set.
So the art isn't just in the calculation, it's in judging the story behind each number. Is this multiple a real signal, or is it just noise?
That's where an analyst really earns their keep. And that judgment call leads us right into the final 3 steps, which are all about application and, more judgment. Step 5 is pretty mechanical. Create the valuation range. You take your clean, normalized multiples, let's say they're 9.5x, 10x, and 11x EBITDA, and you find the median or the interquartile range. That gives you a tight, market-based consensus.
And then step 6, I assume, is where you finally bring your own company into the picture. Apply to target.
You got it. You take your target company's latest EBITDA, for instance, and multiply it by that range of multiples we just found. That gives you an enterprise value range, but you're not done.
Right, you have to account for the debt.
The crucial can't forget it step. You then subtract the company's net debt to get to the equity value. That's the number the shareholders actually care about. That's the check they get.
It's amazing how often that gets missed by people new to M&A. So what's the last step? Step 7.
Step 7 is the final layer in judgment. The calculator gives you a range, but you have to use your brain to refine it. Is your target company growing faster than the comps? Is its management team better? Are its profit margins higher? These qualitative factors help you decide if the value should be at the high end or the low end of that range.
And you mentioned a pro tip here.
Oh, a big one. Always, always separate your buyers. Strategic buyers, like a direct competitor, almost always pay more than financial buyers, like a private equity firm.
Why is that?
Synergies. The strategic buyer can combine operations, cut costs, and create value that just isn't there for a financial buyer. So if all your precedent deals involve strategic buyers, you can justify a higher multiple.
Let's make this real. I think a case study would be perfect here.
Yeah.
You mentioned the 2018 acquisition of Fortis Healthcare in India by IH Healthcare.
Yeah, it's a fantastic example. It shows that strategic control premium in action perfectly. Fortis was a huge hospital chain in India.
Yeah.
At the time of the deal, the implied enterprise value was about 9,000 crore rupees. Their annual revenue was around 4,600 crore, and EBITDA was 750 crore. So when you do the math, you get a couple of key transaction multiples.
What were they?
The big one was EV to EBITDA, which came out to 12x, and the EV to revenue was about 2x.
Wow, 12 times EBITDA. For a hospital chain, that feels pretty high. That has to be the control premium you were talking about.
It is 100%. IHH, the Malaysian buyer, was paving for immediate dominant market entry into India. That 12x wasn't just for Fortis's existing cash flow. It was a bet on the future value of that market share and the synergies they could create. It's step 7 judgment in the real world.
They were pricing the potential, not just the performance. Okay, so let's use that. Let's pretend we're advising a similar but smaller hospital chain. How would we apply this?
Perfect. Let's say our hypothetical peer has revenue of 2,500 crore and EBITDA of 500 crore and about 300 crore in net debt. We take the multiples from the Fortis deal, that 12x EBITDA and 2x revenue, and we apply them. So first, let's use the 12x EBITDA multiple.
Okay.
You multiply our peer's 500 crore EBITDA by 12. That gives you an enterprise value of 6,000 crore.
And using the lower revenue multiple.
Right. You take the 2,500 crore in revenue, multiply by 2x, and that gives you an enterprise value of 5,000 crore. So now we have a defensible range, somewhere between 5 and 6,000 crore.
Based on what the market actually paid for a similar asset.
Precisely. And then the final move. We take that range and we subtract the 300 crore in net debt. So the final equity value range, the money the seller gets, is between 4,700 crore and 5,700 crore. Now, that is a powerful number to take into a negotiation.
It absolutely is.
Yeah.
So we've seen the power of PTA to ground a valuation in reality.
Mm-hmm.
But, no tool is perfect. We have to talk about the trade-offs, the limitations.
Of course. The advantages are clear. It's based on market reality, not a spreadsheet forecast. It automatically captures that control premium. And it's an incredible negotiation tool.
But the downsides can be tough, especially for smaller deals, right? The first one has to be just finding the data, limited data.
It's a huge problem. For niche industries or lower middle market companies, there just might not be many comparable deals. And even if there are, the details are often private.
And what about the age of the data?
That's the other big one, market evolution. A deal multiple from 2019, when money was basically free, might be totally useless today in a high interest rate world. Markets change, and you need judgment to know if an old deal is still relevant.
So it's not a set it and forget it kind of analysis.
Not at all. And that's precisely why we always stress the importance of triangulation. You never, ever rely on just PTA. You have to combine it with a forward-looking DCF model and with the real-time pulse of trading comps. Using all three gives you a much more robust, well-rounded valuation.
Fantastic. So I think the big idea for you to take away from all this is that valuation isn't just an academic exercise. It's not just about what a company is worth on paper. Fundamentally, it's about understanding what real buyers have been willing to pay for control.
And maybe that leaves us with a final thought for you to chew on. If precedent transaction analysis is based entirely on historical prices, how do you, as an analyst, decide if a past market cycle is really a good reflection of today's world? With totally different growth expectations, different costs of capital, different appetite for risk.
Right.
That's the moment where the art of expert judgment completely takes over from the science of the calculator. And that's where the real money is made.
Right.
Or lost.
Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace, or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.